Hey, what's going on, traders? Thanks for checking out this video. My name is Travis from Master the Market, and in this one, we're going to talk about 5 day trading penny stocks rules that I believe you need to follow in order to successfully profit from the penny stock market. So without wasting any time, rule number 1 is going to be to start small. So to ask you a very simple question, would you rather lose 50% of $1,000 or 50% of $20,000? Now, obviously, losing $500 is a lot less than losing $10,000, so starting off with an account value of $1,000 is probably going to be a better decision than starting off with an account of $10,000, $20,000, or $50,000, because as a new trader, you ultimately have to expect to take a lot of pretty consistent losses until you really start to understand the penny stock market and until you start to put some strategies to use with your trading. However, the nice thing about this is if you start small and you start with maybe a few hundred or even up to a few $1,000s depending on your financial situation, you can still learn the same lessons that you would learn if you were starting with $10,000, $20,000, $50,000, but those lessons are going to be a lot more affordable and you're not going to lose a ton of money by doing so. In other words, when you start trading, it's actually going to be much more important to think about how much you stand to lose rather than how much you can actually profit. And this is a problem with a lot of new traders. They think, if I put $10,000 into this new trading account and I make 50% in the next month, I can make a $5,000 profit. But unfortunately, as a new trader, that is very unlikely, and you have to kind of think a little bit more about how much you stand to lose rather than how much you stand to profit. So rule number 2 is going to be to look left. Now, what I mean by this is the left side of your chart is going to be that chart's history, and believe it or not, just like many other things in the world, history often repeats itself in the stock market as well. And if you think about it, that's exactly how levels of support and levels of resistance actually form on our charts. For example, by definition, a level of support is a price level where historically the stock has a difficult time breaking below due to a larger amount of demand than there is supply at that price level. And it may sound pretty obvious, but by looking left and looking at your chart's history, you can find out a lot about how that stock typically performs in certain situations. So for example, if we take a look at this chart for PSTV, this was a stock that I recently made a profit of a little over $1,000 on with a quick day trade. And believe it or not, the way that I did that was by simply looking left and looking at how this stock typically performs when it has a gap up from the previous day's close. So this is the day that I made the profit on. And as you can see, it had a pretty big gap up from the previous day's close. It closed at about $1.90 and gapped up to about $2.30 the following day. And by simply looking at the past 5 or 6 months, you can see that just about every single time this stock has a big gap up, it ends up closing well below the price that it opened at for that day. So we can see that happening right here, another time right here, and another time right here. So by seeing that, that's what gave me the confidence to look to actually short sell this stock to profit from it coming back down after it had that gap up on this day. That short position ended up making me a little bit over $1,000 profit, and really all I had to do to make that money was look to the left of the chart and see that this stock has a history of gapping up and then coming straight back down. Okay, so rule number 3 is going to be to keep it simple. At the end of the day, the price action itself is going to be a lot more beneficial and a lot more useful than all these different lagging indicators that you may have on your charts. For example, a lot of new traders are going to have charts that look something like what we see on the right side of the screen here. Now this chart has a ton of different indicators on it. We see multiple different moving averages, we see Bollinger Bands, we see the MACD, the VWAP, and so on and so forth. And this is not to say that these indicators are not useful and can't be used to successfully day trade the penny stock market. But at the end of the day, having all of these together on one chart is really just clouding up the things that matter the most when it comes to day trading, and that's the price action itself and what's actually going on in real time. All of these indicators are kind of lagging behind the real-time price action, and they're simply making things a lot more complicated than they need to be. Instead of having all of these different crazy indicators on your charts, I personally like to keep it simple, maybe have a few lines of support and resistance drawn on my charts. I'll draw different trend lines when I see them. I'll use maybe the VWAP and a few other simple indicators. But then I focus a lot also on the level 2 and the time and sales, which are something that are completely separate from the chart itself. But by doing this, I can very clearly see the chart itself. I can see the real-time price action as it's going on, and I'm just keeping it as simple as possible without having a ton of different studies or indicators on my charts. Okay, so rule number 4 is going to be to avoid pump and dumps. Pump and dumps are actually a great way to make money if you are an experienced trader. You can find them early on many times and ride the momentum to the upside, or you can wait for that momentum to die down and you can actually look to short sell them to profit from them coming back down. But again, that is for more experienced traders. And if you're a new trader, it's best to avoid pump and dumps because many times what happens is you're going to end up getting caught in the dump and taking a loss as the stock is coming back down. So these pump and dumps are becoming a lot more common nowadays because there are many different Twitter accounts with 20,000, 50,000, even 100,000 or more followers that actually tend to pump and dump stocks. And what this may look like is they're going to buy a ton of XYZ, for example, and what they're going to do is continuously over the next few days talk about XYZ, telling all of their followers how much potential it has and how high it can potentially go. And as the stock is then spiking, they're going to sell for a large profit. And a few days later, they're going to be posting about how much money they made on XYZ. They're going to be sharing pictures of their Lamborghini. And ultimately, they're never going to be talking about XYZ again. Meanwhile, all of their followers that bought XYZ because of their tweets are now taking a loss because it's dumping back down to lower prices. Okay, so just know if you see somebody on Twitter that is continuously talking about one single stock for a few days, and then a few days later moving on to a completely different stock, never talking about that past stock again, most likely all they're doing is pumping and dumping, and for the most part, you probably should avoid their recommendations. So just for a quick example, this is kind of generally what a pump and dump chart is going to look like. We can see that for the most part, up until this day, this is pretty much a dead stock. It's downtrending a little bit. It's trading with very low volume. And this is when the person that is leading this pump and dump would be loading up on shares. They'd be buying small amounts at a time. And then they would start to pump the stock, and that's what's going to cause this spike here. And while this stock is spiking, and while all of these people are following this pumper, that's exactly when they're going to be selling and locking in their profits. So once the price does dump back down, they've already made their money and they're already out of the trade. Meanwhile, there's going to be a lot of people that follow the lead of this pumper that bought at $3, $3.40, $3.50, and so on and so forth. And now the next couple of days, they're going to be holding on to a big loss as the stock got dumped back down to under $2 per share. So this is a classic pump and dump chart, and you can usually spot them pretty easily because they are going to be generally very low volume stocks that all of a sudden have a massive spike in volume and a massive spike in the stock. And of course, 9 times out of 10, when it is a pump and dump, that spike is going to not have any kind of news or any kind of press release put out by the company to actually justify that move to the upside. All right, so that's going to lead us to rule number 5, and that's going to be to sell your day trades. Now, what I mean by this is if you enter into a trade as a day trade, do not let it become a swing trade. This is something that everyone is pretty much guilty of at one point or another in their trading career. You get into a day trade, you think it's going to work out great and you're going to make a bunch of money. However, maybe the stock trades sideways for a while, it takes a lot longer than you expect, and the end of market hours creeps up on you, and now it's time to either hold the position overnight in hopes that it's going to work out the following day, or stick to your plan and sell your shares because the reason that you bought the shares in the first place was because you were expecting to be a day trade. In my opinion, it is very important to sell your day trades because if you're in the position where you're thinking about whether or not you should hold it overnight, that already most likely means that the trade is not necessarily going to plan because when you planned it out in the first place, it was already going to be a day trade, and now you're in the trade for much longer than you anticipated, and you're put in the position where you now may want to hold it overnight. At the end of the day, holding a trade overnight that was initially going to just be a day trade is simply adding a lot of unnecessary risk into your trading and is going to cause a lot of unnecessary losses that you can easily avoid by simply cutting your losses or locking in your profits on that day trade while it is still a day trade. Alright, and those are the 5 rules that I believe every penny stock day trader needs to follow in order to successfully start trading the penny stock market. Hopefully you found some value in these rules and hopefully you enjoyed this video. If you did, please make sure to like the video and subscribe to the channel so you don't miss out on future videos. And if you like this type of educational content and you want to learn more about day trading, swing trading, and long-term investing, as well as have access to our trading chat room that has over 1,000 active traders in it every single day. All of that can be found on my website, Master the Market, which is going to be linked down below in the description. But anyway, thank you again for watching. I hope you enjoyed, and good luck with your trading.